I am super excited for this. I appreciate all of you joining. So we're joined by Rob Anderson, who is the founder and principal at Carlton Lane Capital. I've known Rob for a number of years, and he's really kind of the consummate real estate expert who has gone through it himself as well. He started as an active investor, buying real estate properties and running them himself. He moved into then crowdfunding deals in terms of like syndications and funds and everything like that. And recently just founded Carlton Lane, where they're a very boutique and curated real estate operator. And he has agreed to join us and share all of his perspectives on essentially like how do you vet a deal? How do you find good deals? How do you find recession-proof deals? How do you find deals in all markets? And this is super important. I've always said, when you're investing in private real estate equity like a fund or a syndication, you're handing your money over to someone else who you're trusting to run it well. And so you want to make sure that you understand the deals yourself. You also want to make sure that you trust the person you're working with and that they have been through everything. And so Rob is here to kind of go over all of that with us, which I really appreciate. So Rob, thank you for being here. I will turn it over to you. And just as a bit of housekeeping, if you have questions as they come up, certainly throw them in the chat. We will have dedicated time for Q&A at the end. But if you have a question about something we're going over as it's happening, throw it in the chat and we'll stop and go over that. So with that said, again, thank you, Rob, and I'll pass the baton to you.
I appreciate that, Jordan. We can absolutely go into due diligence to the nth degree, but I figured I'd put everybody to sleep if we did that. How to break apart a financial model and how to understand if a developer's lying to you or not. That would be a whole nother thing that we could do at some point. But because unfortunately I have seen that. The what we wanted to talk about, and I had titled this Clarity Before Capital, is understanding that. So from a due diligence perspective, that's incredibly important, right? The However, there's a lot of headlines right now. It's been a crazy year. And so how can we invest like the smartest people in the country do and protect ourselves? Because a lot of people think that in order to de-risk my portfolio, I have to give up return. That's not true. In the past, what we did is we went into more into bonds or more into cash or more into, maybe dividend stocks or something like that that would we thought would de-risk our portfolios, and then we were giving up return in order to do that. The purpose of today is to talk about how we can still de-risk ourselves from different times in the economic cycle, like if a recession hits, if inflation comes back, things of this nature, without giving up return. So you can get better, equivalent or better return without doing that. So let me go ahead and move along here. So the current headlines. Obviously Iran is pretty big in the headlines right now. Inflation is always, it seems like, for the last several years in the headlines. And I'm going to turn and look at my screen to the right, so you guys just ignore me when I do that. But there's been a lot of concerns about recession, tariffs. Do we forget about tariffs? Tariffs was such a big thing and it's kind of gone. Stock market valuation. I'm going to talk about that too. The stock market's done great. I've enjoyed it too, but is it a bubble, right? There's a lot of things that people call and ask us. We've had such a busy year, we forget about even Venezuela. I didn't even put Venezuela on the slide. That happened this year. So there's so many things that have happened. And by the way, I just want to stop. Jordan mentioned if you have a question, please let us know. I would love to just take it when you think about it, because a lot of people, when they have a question, if they don't take care of it right then and there, it just kind of never happens. So please, I'd love this to be conversational. But the headlines are amazing as to what's going on this year. And so it really kind of makes you wonder, do I need to protect for the future? Like, what do I do? I mean, oil has been $100 ever since we went into Iran. It's got about a $40 risk premium on it. It should be around $60. Interesting note, over the last 20 years, the average price of a barrel of oil, anybody know what that is? I'll just go ahead and spoil it. It's $72. Now, it's obviously been a lot higher than that, a lot lower than that, but over the last 20 years, it's averaged $72. So we want to get it back to $72, frankly. But what's interesting is why does the price of oil matter? Well, because people are concerned about how it would affect inflation in the overall economy. But did you know that gasoline purchases are only 2% of discretionary consumer spending? We are a consumer discretionary spending country. Two-thirds of our economy is based on that, right? And only 2% of that is the price of the pump. So a lot of that's overblown. I guarantee you nobody on this call was affected when they paid an extra $20 to fill up their tank. It obviously affects the lowest in the economic in the economy, and that's an important thing to address, but it doesn't necessarily lead into it. Where it does is things like jet fuel, transportation costs, things that lead into other things is where we're really going to see that. The 10-year treasury at 458 is not healthy. And as a real estate guy, it hurts to even just say 458. That is an incredibly high number for the 10-year treasury because when you do long-term financing, you have an index plus a spread, right? And so when you're going to finance the purchase of, let's say, real estate or something larger over a longer period of time, it's based on the 10-year treasury rate. Short-term financing is based on pretty much SOFR, which is the Fed funds rate. So when the Fed lowers, it helps short-term financing. It does absolutely nothing for long-term financing. Why does that matter? Those of us that have invested in real estate, and maybe some of us, like I'm one of them, you're in a deal and you're like, when am I ever going to get out of this deal? And you keep calling your sponsor going, when are you going to sell this? And they're not going to sell it because they can't get the right price that they want. And the reason is the 10-year treasury yield. CPI is up 3.8 through April, and PPI is up 6.4 through April. Inflation came back, and a lot of this is because of the impact of the price of oil and some other things, because it was down. I mean, we got down to 2.5 for a while there. And this is an interesting thing that I think a lot of people don't realize. The price to earnings ratio on the S&P 500 is currently in the 30 to 31% range. The historical average is 16 to 20. We are considerably overvalued today in the stock market purely based upon this one metric. Does that mean it's a bad place to be? No, but it's something we look at, right? So I've made a bunch of money in the stock market. The stock market's had an unbelievable run. Is it going to continue? Will it continue at the same pace? We got a lot of high profile IPOs coming up that are pretty, SpaceX is one, for example, that's pretty interesting. I don't know that answer, but what's interesting is the stock market is no longer the one for one indicator for the overall economy. Did you know that we have half the number of stocks available to us today that we had 20 years ago? Companies are not IPOing nearly as fast as they used to. SpaceX is a great example of it. Musk took forever to take this thing public. Why? Private equity is holding on to these companies longer and longer and longer. And what I mean, the reason I'm going into this is just to make the point that just because the stock market is doing what it's doing doesn't mean it's not a direct correlation on the economy. Because we just don't have as many publicly traded companies anymore due to the just all the onerous rules that go into running a publicly traded company due to Sarbanes-Oxley and a lot of other laws that have happened over the years. And so what are happened are people are keeping these things private for longer. So how do we invest in these uncertain times if you kind of look at it that they are uncertain? And that's what I want to talk about. So the solution is obviously we've already spoiled it. There are recession resilient asset classes. So what is a recession resilient asset class? Well, number one, it's got to keep pace with inflation or actually benefit from inflation. So what would benefit from inflation? I don't know, rising rent. Oil is a great one, right? That's completely inflationary. But if you invested in it, your cash flow went up as it went up. And so there's things you can invest in that will go with it. And then obviously we don't want to be too hurt by tariffs, even though it seems like it's almost much to do about nothing nowadays, but it is still there and it could come back, right? And so that's a lot of what I want to focus on. So then if you think about potential recessionary concerns, where are we in the economic cycle? That's the million-dollar question that people are always curious about or asking. Quick refresher, we go through an expansionary period, we peak, and then we have a recession or a pullback, we recover, we do it again, over and over and over and over again, right? Now, we haven't had a significant recession, COVID aside, since '08, and then prior to that, '01, '02, and there's a few back further behind that. COVID was absolutely a recession, but it was so short-lived. It was just boom, boom. But what's interesting is how do you know where we are? And it really depends on what you're in. So there's different things that are in different cycles of the economy. The stock market's at all-time highs right now, and a lot of it is that AI boom that's happening with the tech stocks, right? Last couple of years it was the Mag 7, now it's the chip stocks, and it just keeps on going down this path. So we don't really know, and that's kind of the issue, the point I'm trying to raise here. Commercial real estate's bottomed. You know, with the Fed raised 525 basis points and what it did to the 10-year and financing, banks just shut down financing. There's been a repricing going on for about the last, I don't know, 12 to 18 months, but most notably in the last 6 months. I have seen more deals reprice 20 to 30% below the prior capitalization than I've seen in 10 years. And so what's interesting about that is one of the things that we're seeing is it's very opportunistic. So real estate would be at the very bottom of that recession going into recovery. And if the 10-year wasn't at 458, we'd be full sweep, we'd be full bolt into recovery. It's kind of stalled a little bit. But because of the repricing that you can come into some very good assets at a much more favorable basis, it is starting to be a little bit more compelling. Bitcoin is down. There's another one, right? That used to be the great diversifier out there, and then all the institutions got into it and they started trading it like tech stocks. Crazy thing to think about. One of the biggest concerns about Bitcoin right now is that they think there's starting to be some talk that quantum computing will actually be able to break Bitcoin. And if that were to happen, Bitcoin becomes completely useless. Isn't that wild? Have no idea if that will happen or not. But that's kind of one of those things that's starting to give people pause. I still own Bitcoin. I'm not telling you guys to sell Bitcoin. I'm just giving you some thoughts about how people look at this stuff in the more institutional circles. Gold and silver are up. The mining stocks, good Lord, if you haven't seen those have been on fire. Why is that? Inflation and the dollar. Same thing with oil and gas. Obviously, we know what's going on with Iran, and oil and gas is up as a result. So once again, here's my point. By investing in recession resilient asset classes, it doesn't matter where we are in the economic cycle. You don't have to worry about it. If your portfolio is truly created in a way to where part of it's going to perform here, part of it's going to perform here, because that's the whole point about diversification, is that they are uncorrelated. They don't go up together, they don't go down together. So when I got into the business back in the 90s, when I first got securities licensed, we were taught diversification was large cap, mid cap, small cap, growth, value, and a couple bond funds. I mean, if we were really, really crazy, we looked at a REIT. And that was diversification back then. But then what happened is in 2007 and 2008, or the crash, the great financial crisis, they came together more than they ever have before. They all fell together. Now bonds recovered quicker, but every asset class was hit the same way. This was further exacerbated during COVID. If you go back and look at all the different asset classes during COVID, they all went down together. They all came up together, unfortunately. So if you go to that old diversification I mentioned from the 90s, and you think all your eggs aren't in the same basket, they are. They're in the same basket. They're just spread out inside that basket. And that basket still goes up and down. Unfortunately, the correlation is too great right now, and that's where alternative investments come in. And the endowments out there, the Yale endowment did it first, and everybody followed. That is why everybody is so keen on alternative investments to find truly uncorrelated assets. So this way, you don't have everything in your portfolio up or down at the exact same time. Granted, we don't want it down, period, but that's just the nature of things. Stock market goes up every 4 out of 5 years. On average, 1 out of 5 years, it does come back down, right? And that's just something that happens. So if we can create a portfolio where it doesn't matter where we are in the economic cycle, we all sleep easier at night and we can go about our business. So how do we do that? And that's what I prepared for you guys. So to build a portfolio that can hold up in this recessionary environment that we may or may not have, we definitely have an inflationary period. Like, what are some of the characteristics we look for? First off, whatever we're investing in, does it have the ability to raise prices quickly? Right? If things get more expensive, can it raise its revenue to meet the rise in expenses? That's an important thing to look at. And some things can and some things cannot. Essential use demand. My favorite here, people always laugh at this, is if you follow Starbucks during a recession, it's hilarious. You'd think Starbucks would be something people could cut out of their diet. No, they can't. No, we're so addicted, it's unbelievable. My daughter will never skip getting that $6 drink that she gets all the time. it's a joke, but the point is we all have essential things that we're going to spend money on no matter what. And those are the things that are unaffected by changes in the economy. Asset backed, asset backed, asset backed, asset backed. I'm going to beat that drum. You've got to be asset backed today. The wealthiest people in America have the majority of their wealth in asset backed investments, period, by none, bar none. So you've got to be asset backed. It keeps pace with inflation better than just about anything. If you can have something that's limited supply or there's a barrier to entry, that is even more advantageous. Those of you that have been following me know that we just did a student housing deal at the University of Texas. I love that because getting a piece of dirt in that little submarket is next to impossible. So limited supply, once again, not going anywhere. If I can find something like that, I'll always try to do it. Shorter lease durations allow you to raise prices quicker. That's why you want shorter lease durations. Love net lease, but you just signed a 10-year lease. It's what it is. So that's something to consider. Um, what matters there are your rent bumps or your escalations in your rent every year in pace with where current inflation is. And a lot of them are nowadays. They've reset, but that's something to look at. And if you can get an inflation-linked cash flow, then you've won. And that's one reason oil and gas is so popular right now is because it's the most tied to it. And then you definitely want very low obsolescence risk. You don't want it to disappear on you, right? You want something that's not going to go away. And if we're doing something that has debt, we've got to have fixed rate debt. There's already a concern the Fed may actually raise rates based upon what's going on with inflation. I know the new Fed chair came in. He's going to have his hands tied if CPI and PPI are still at those levels. He's definitely not going to lower, and he may be forced to actually raise again. So it's one of those things. So what is the common thread here? Hard assets tied to an essential human need that can reprice income faster than inflation rises. That's a mouthful, isn't it? But it's the thesis of this whole conversation. So I'm going to say it again. You want to own hard assets that are tied to essential human needs, meaning it's not going to go away, that can reprice or raise revenue faster than inflation rises. Just by definition, that's what we're looking for. Okay. So what is that? So I just spoiled it with my fancy little graphic that ChatGPT made for me. I'm going to wrap myself out on that one. I did not find this. I created it. But what are we prioritizing to find these recession asset classes? Housing is the most basic of all human needs, right? We have to have a roof over our head. There are parts of the economy that are overbuilt. There are parts of the economy that are underbuilt. We're going to talk about that in a second. Industrial, because there's essential things, there's essential needs that industrial fulfills from a real estate perspective. Infrastructure is not even just real estate. It could be a lot of different things that we can't live without. Utilities is one, for example, right? We're not going to not pay our light bill. So there's interesting ways that you can invest in things like that. Energy, I mentioned it a few times. Energy is so important right now. Medical, where everybody is on this call. You guys are in one of the most recession resilient industries ever made, flat out. I'll say it again later, but I'd be curious to take a poll and say, did your business change at all during a recession? My guess is it probably didn't, or it didn't much at all, right? If you're hurt, you want to feel better. You don't care what the economy's doing. If you're sick, you want to feel better, and you do not care what the economy's doing, flat out. So I'm a big fan of medical office. I'm going to talk about that later. Necessity-based assets. I've been saying this over and over again. If there's a necessity-based, like food, like gas, banking, just things that people are going to spend money on no matter what, those are the great places to be. So once again, hard assets tied to essential human needs that can price faster than inflation. I'm saying this over and over again because I want you guys to understand how we look at this. Okay. Now, so let's start with housing. I bet you most people have invested in a multifamily investment. They're very popular. They've done so well over the years. The 20 teens were incredibly was a bull market in multifamily investing. The last several years have been a little tough just due to interest rates. So you've got different ways to play housing. You got multifamily, you got single family, you got build for rent, you've got student housing, you've got senior housing, and I could go on and on and on, right? But housing is so location dependent, So back to the due diligence that Jordan started off with. There's third party market studies. Anytime you go to invest in a deal, you want to ask the sponsor for their market study. If they act like they don't know what they're talking about, don't give them money, flat out. So every developer that goes to do a multifamily deal will get a third-party market study done. And what it does is it tells them the supply and demand in the area. It tells them the rents. It tells them the rent growth or the expense growth. All of this is data that can be found. Okay. So whenever we do it, we always get third parties. I want to see the third-party data. I shared this little graph here just to show you the supply and demand change. Now, this is national. So keep in mind, real estate's very localized. But as you can see, the demand doesn't overtake supply until this year at some point. We've had way too much supply. We came out of COVID and built so many apartments, it's unbelievable. And in every city in America, there are a few cities out there that have actually recovered from a supply and demand standpoint. My two favorite are Atlanta and Houston. I live in Dallas. I don't put money in a Dallas multifamily for new construction. We have way too many units here. And this is the market I know the best. And so you got to look around the country and see where are absorption versus rent growth or new units, right? So it's not just permitting. It's what new units are coming on the market versus what absorption is happening in that market. It's just simple supply and demand. And so when you're looking at a multifamily property, and multifamily is still going to be a great thing to do, it's one of the best appreciation plays you can do, is you've got to make sure that you're not in an oversupplied market. So, like I said, the two that I've seen come out of it the best are Houston and Atlanta. If you see a deal in those markets, I would definitely dig in if it's new construction. What we're seeing in housing is a shift from new construction back to what we used to call value add. Value add's a renovation project, a large fix and flip, for lack of a better term. So you buy a property that's a little older, you either reset the basis, which is what I'm looking for right now, and you can actually assume debt. I've got a deal right now. I'm in due diligence on. It's got a 9% cash flow. This thing's built in the 60s. It's full, and we're resetting the basis because the prior group, unfortunately, is getting washed out. We're coming in at about a 25% haircut to what they paid for the property. Well, man, I feel bad for them. That's a phenomenal place to get into this property, right? We don't even need to do anything. The units were already renovated. We've just got to hold it and cash flow it, and we'll make our little 2x down the road in a few years. That's how I would tell you to play multifamily going forward. Is specific on a market. Looks like we have a chat question, but specific on the market, number one, and then further, if that market is oversupplied, we got to go back to value add. It's finally time. Value add didn't work for about 6 years. We have a question, Jordan?
Yes. So, great follow-up question. Anurag has a question of, so on the chart, it looks like vacancy is still lower than demand, but are we anticipating better demand, consistent with 2026? So are we expecting that demand, I guess, to rise again?
Well, eventually vacancy would fall, right? But it takes time. And keep in mind, these are projections.
Right.
But he's right, Now, vacancy at 7% is livable. That means you're at 93% occupied. That's technically stabilized. You can sell a property 93% occupied. I'd rather have it 95. But if you look at the chart, now 8, 9%, where you're only 90, 91% occupied, it's kind of on the bubble. You may not get the best value for it. So back to his vacancy question, right? So there's two things to look at. You can be 100% occupied and be in a really bad position. And that's what's happening right now. So you have to look at concessions. So a concession is something that the property owner is giving the person who's going to come rent that unit. Right now, they're giving 2 to 3 months free. I've seen people give out gift cards, flat screen TVs. I've seen trips on cruises. I know a property that's giving away a free cruise if you rent an apartment. I mean, and what is that? That's expense, right? And so your property's full, but what happened to the expense line item on your income statement? It went through the roof. And so NOI is income after expenses, just simply put, right? And so you've got to watch that. What a lot of people did is they said it's better to have our properties full, not at the rents we want, than the alternative, right? And so they were giving away the sun, moon, and stars to get people in these units from an occupancy standpoint. So vacancy, yes, important, but at what cost? That's kind of where I'm going with it. Okay. But yes, we have a significant issue. If you watch 21, vacancy was down to 5, 6%, and it popped up to almost 10%. And this is nationally, this is everything in the country, right? Every market's going to be unique, but it's very, very interesting way to look at it. Build for rent has actually done a very good job. Those projects, I'll admit, I was a doubter at first. It's really just a horizontal apartment complex, is what build for rent is. You build these little bungalows, and people don't have anybody above or below. Those have actually done really well. Their retention rates are better than normal multifamily. At the end of the day, it's all about location. Is your location more desirable than somebody else? And are you running the property well? I mean, that's kind of where it comes into. So, okay, senior housing's in vogue right now due to the aging baby boomer business. I'll give you one caution though. It is an operating business. It's an opco. Senior living is the most operationally intensive piece of real estate, far none, bar none. I don't even consider it real estate, frankly. I consider it an opco. It's like investing in a business. And so if you're going to go into senior living, make sure you do the due diligence on who the manager of the property is, how many other senior living properties have they done, do they have experience, what's their track record. That is by far and away more important than the developer. The property manager in senior living is so important. I can't stress that enough. Unfortunately, I know of multiple that have been washed, and it's all purely due to the operator. So, much more important is the manager than the developer in senior living. That said, if you got a good manager, a good operator, senior living is statistically underdeveloped depending on the market. We're a little overdeveloped here, but it just depends on where you are. Most of the country is underdeveloped there. Student housing is very dependent on the school. You pretty much have to stay Power Four. It's a safety net if you're Power Four. Granted, there's brilliant colleges around the country, but from a demand perspective, that's kind of what the institutions like to trade. Just kind of interesting how that works out. All right, for time, let's get moving. Industrial is interesting because of the data center buildup. I'm going to be a little controversial. I think it's a bubble. You're welcome to disagree with me. I think we've built way too many. There's a data center in Utah that is going to take more electricity than the entire state of Utah. It is unbelievable what's going on with these things right now. Now, what they're not telling you is most of these data centers are creating their own energy separate of the grid. And that's because they're being forced to do that. It's very interesting how they're doing this. Look at that. I love this chart. From the launch of ChatGPT till now, look at that upward trajectory. That is just fascinating. The amount of compute power we're trying to build. Here's why I'm concerned about it. I love industrial. I love small bay. I love manufacturing. There's a lot of reshoring of manufacturing going on. And but I'm big into value add when it comes to industrial. Be careful with new builds. There's been a lot of building in industrial. Now, why am I concerned about data centers? Well, the size of these data centers is based upon today's technology. What happens tomorrow when they create a technology that has the exact same compute power for 1/6 the need in that building? What does technology always do? It gets faster and smaller, right? At some point, we won't need a 1 million square foot warehouse to do what it does today. We'll need half of that and then a quarter of that. Now, maybe the compute power will continue to grow. It probably will, but we just don't know. So if you can get in and get out, probably a good idea. I'm not a fan of holding it long term. I think the technology will outstrip the demand for the space is a concern that I have with data centers right now. E-commerce not going anywhere. Manufacturing is growing. If you don't know what small bay is, they're small pieces of a warehouse where you generally will have somebody use it in a combination of office and some sort of logistics or manufacturing in the back. And what you'll have is you'll have a warehouse that might have 20 or 30 tenants in it, and they're all small tenants. And so they're not investment grade tenants, but there's thousands of them. So if you lose one, there's hundreds more that you can recruit in. And so it creates a stabilizing factor, and that's why a lot of folks have gravitated to what's called small bay industrial. So interesting thing going on right now. Infrastructure. Infrastructure is probably one of the safest places to play recession-proof investments. The problem is they're hard to get into. They're really, really hard to get into. The institutions and the biggest of the big gobble them up. Why? They're expensive. Power plants, water plants, airports, train, rail lines. Think of cell phone towers is one you could probably do, but think about what would be infrastructure related that's not going to cost billions of dollars. My example here is food. And we've got a way that we play this right now. What we're doing is we're playing the food value chain. It's very obviously there's no obsolescence risk because we have to eat. We're we're not going to stop eating, but it's a very interesting thing if you look at the chart, the compound average growth rate or CAGR. I mean, it just kind of just goes, right? And as populations grow, obviously the need for food grows. This is a great way to play industrial and infrastructure in the same play. Because what this like, for example, one of the funds that we work with, they're buying industrial properties in the food value chain where they're making food or they're at the farms or they're in some sort of production line of it. So it's a really interesting way to look at it. Farmland is a big one right now. Hard to get into, but just giving you guys ideas in case you come across it. Incredibly resilient from a recession standpoint. Why? We always have to eat. We always have to eat. So infrastructure is an interesting one. Hard to play though, so I like to bring up the food option because there are ways to do that. If you'd like to see it, let us know. Okay, energy is one of my favorite right now, and I'm a real estate guy. There's a lot of reasons for that. My example here is mineral rights. It's land. It's real estate. You can invest in mineral rights. You're investing in land with a cash flow. Land with a cash flow rising faster than inflation. That sound like one of my prior slides? So what's interesting is it's such a natural hedge to inflation because it goes up with inflation, it goes down with inflation. If you've never looked at mineral rights, it's very, very hard to get into up until recent because, frankly, the wealthiest families in America would just never sell it. Right. Well, now you've had a transition where the heirs are picking it up and the heirs don't want to mess with it. They don't know what they have and they don't know that ExxonMobil wants to put 20 new rigs on their land, so they sell it to you. And so the access to the data is fascinating. If you don't know how it works, a mineral rights owner gets 15 to 25% cut of all gross production that happens on the surface, no matter what it is, right? Zero drilling risk, zero capital calls, zero expense, period. They're doing all the risk, and you get a 25% cut of everything that they do. And so if you're investing in, say, the Permian Basin, anybody see Landman? That's a real thing. Permian Basin's the number one oil and gas play in the world. If the Permian Basin was a country, it'd be the third largest oil producer in the world immediately. Okay, the Permian Basin goes West Texas. It's primarily West Texas and a little piece of eastern New Mexico. That's the Permian Basin. It's the number one oil play in the world. Interesting way that people do this. So energy is a very interesting thing that happens when they buy and sell mineral rights. They don't do it on today's price of oil. They spread it out over a 7 to 10 year period. So you're not buying high today. That's one of the concerns about investing in energy. Well, am I buying high today? You're actually not because of the sophisticated nature of this. They spread it out because they know the price goes up and down. Okay. So very interesting way to play this. Gold and silver is another one, right? But that one's even harder to get to. We actually have a mineralized deal. So in today's world, investors like us on this call actually finally have access to participate in things like this. Very interesting way to play it. It's immediate cash flow. Cash flow kicks in within about 6 months of the investment and it just happens every quarter. So I like it from an inflation hedge because if oil goes up, my cash flow goes up, right? If pricing comes down, well, my cash flow may come down, but it still happens, right? Because we still have such an immense need for energy in the country and especially the world right now with what's going on overseas. Okay, medical real estate. So I am the biggest fan of medical office for two reasons. Number one, like I mentioned earlier, it's the most completely uncorrelated asset class to the economy because if we're hurt, we want to feel better. If we're sick, we want to feel better, right? And so people will still come. Now, you guys probably know this, but when I'm talking to non-medical related individuals, I explain what's so interesting about this is that you guys never move your offices. Why is that? because statistically, you'll lose 20% of your patients for every mile you move your office. I don't know if you knew that. If you didn't, there's the stat that's out there, but it's really interesting. And so it's hard because you don't want to risk your business. You worked really hard. You went through med school. You paid off those bills, right? All that stuff. You're one of the smartest people in the country, and you've built this great life for yourself. Why would you put that at risk so you don't move? So if you own the building, you're a good place to be. It's a good place to be. Doctors don't ever skip on the rent, and they very rarely go out of business. So we love this asset class. Secondly, the growth in outpatient, right? And so when I was a kid, you had to go to the hospital for everything. And you guys know this way better than I do, and I realize that. But with the growth of outpatient, now you can do so many, and technology, there's so many procedures that can be done in an office suite type environment, which is not a major hospital. It's a smaller environment, better for the patients. It's definitely better economically for physicians. And so it creates more office space that we can then buy. We have a medical fund right now. We're very excited about it. You can make 15 to 18% is the targeted return. It pays 6 to 7% current pay, and you're invested in medical office practices in the South, Texas, Florida, kind of areas, Carolinas. And it's a very diversified fund. You get depreciation. It's really good for depreciation. And you're investing in medical office practices that are generally have surgical suites and they're outpatient in nature. Long-term net leases, typically 3.5% rent bumps on them. Very steady eddy, very uncorrelated to the stock market. One of my favorite funds that we have today. So I just want to make sure I mention that. Um, Necessity-based retail. And I love it. You can't tell what GC is, but it's a coffee shop. People always laugh. Coffee, yes. People will not go without their coffee. Car wash, same thing. Really? People are still going to wash their cars? The people that do, do. Yes, they do. Fast food, gas stations, banking. So necessity-based retail is very important. These people are not affected by downturns in the economy, right? They're going because they're still going to have their business is just not affected for them for the most part. So this is a fascinating way to play it. Retail has gotten a bad word because of e-commerce. Well, there's some retail that you just don't e-commerce. You don't get not very often do you go to Amazon and get a coffee sent to your house, or something like that. Now you got DoorDash and you do have some things like that, and banking is online. You can't get gas delivered to your house. You still got to go to the gas station, right? Unless you have an electric car or something. But so there's a lot of things in the necessity-based retail that can still make good money no matter where the market is. And so I'm going to show you how we play that. So that's kind of the majority of the things. I've got three offerings here just as examples. So the way that we play the necessity-based retail is through debt. We have a fund that normally would cost you $1 million to participate in. I was able to convince the portfolio manager into letting me create a feeder fund of sorts. So you can come in at 50K, 100K. And what you're doing is we're being the bank. And so we're lending to people building that Chase Bank branch, for example. Only takes 9 to 12 months to build that. And what we're doing is we're making money on the construction like the bank would in a first lien position. So if the developer were to default, we foreclose and take the asset. It's a great place to be. It's the safest place to be in the capital stack. The cool thing is you can make 13 to 15% while being in what is generally a fixed income position. Pays quarterly, and the portfolio manager shares in some of the fees because they create fees when they create a loan, they create fees when they extend a loan, and they get fees when the client pays off the loan. And so it's a very interesting way to play the necessity-based real estate. And the whole point here is you can see things that underpin daily life. Things that you're going to use no matter what, they're still going to get built in a good time and a bad time. And if we can be the lender on it, we're in a safe position and we make a double-digit return. I'll take that trade-off all day long. I mentioned my medical fund to you earlier. It's in primarily in southern markets. The first several assets are in Texas. It's high teens total return. It pays 6 to 7% current. It's investing in that medical outpatient space. It's a diversified fund. Once again, very high investment threshold. Normally, we were able to create a way to get in at a much lower investment, and that's why we like it. Student housing, our University of Texas project is full. Sorry, I don't mean to tease you with that. I don't have anything left on it, but we love student housing. It's just an idea. As you can see, there's income, there's growth in income, there's growth. I would say growth going forward would be things like a value added play in housing. I think that's a very growthy way to look at things going forward, or maybe food or oil and gas or something like that. Okay, so real quick on where I'm coming from with this, the due diligence part of this is very important. I have found in doing this as long as I have that investors are entirely too trusting. And not to pick on you, Jordan, but you did say find somebody you can trust. And I'm going to tell you, as the guy that people had trusted for about a decade or more, if not longer, doing this, don't do that. You've got to do your own due diligence. And if you're not going to do your own due diligence, find somebody who will do it for you because you've got to understand the risk. If you've noticed, I didn't tell you about returns until the end of this presentation. I was talking about risk. How do we mitigate risk? If we mitigate risk, the returns actually accelerate. And so most investors outside of this group, because you guys are sharing deals with each other, but it's a friend or a family member is how you find somebody. And I'm a big fan of due diligence. We hire third-party due diligence companies to re-underwrite everything that I would ever show anybody if you guys decide to work with us. And so these are the same due diligence companies that work with family offices and institutions and broker dealers. They're not cheap, but they protect us and keep us from getting into things that we didn't see on our own. Okay. And I can do a whole presentation on that if you want, but third-party due diligence is very, very important. Why? We're all busy people. Plenty of you guys on this call are more than qualified to do it, but do you have the time? Do you have the willingness or energy to do it? Or do you have access to the data that allows you to double check or fact check what's in the PPM? That's one of the bigger issues that I see. And so these third parties that I use have access to the data to fact check and say, okay, you're assuming that you're going to grow rents by 3%, but the market's flat and has been flat for 2 years. Why are you assuming that? I'd like to know that if I was going to put money in a deal, right? We wouldn't know otherwise. So just as an example. And so what I'm trying to find and I challenge my team to do is find asymmetric opportunities where the risk is less than the return. No, the return is greater than the risk that we're taking. Kind of said that backwards there, but that is absolutely doable. Remember, I started this saying people think if to de-risk, they got to give up return. That's absolutely not the case. You just got to do it a little differently nowadays. And this is what we like to do. If we can find an opportunity to de-risk through alternatives, honestly, a lot of these deals outperform like the stock market or things of that nature. And so that is what we're trying to accomplish here. I've got a couple things I want to share with you, but we are completely independent of any sponsor. I'm not beholden to any sponsor. I don't have to raise money for any sponsor. They have to meet our diligence and my third party firm's diligence before I would ever share anything with you. So those deals I shared with you earlier, those have all third party diligence reports that are not cheap. They're 10, 20, sometimes more, $1,000 to create that are done by professional groups that do it for a living. That's how we think we can help people, especially busy people like physicians, create a portfolio that is more balanced. I don't want to use the word protected, but more de-risked to accomplish what you're trying to accomplish. Okay, so I want to share a few ideas with you before I wrap up because I'm 45 minutes in. And so this is some of the things that we do with our high income earners, whether you're a physician or a business owner or whatever you do. There's several things that you need to understand, or at least have some knowledge of to see when it can help you. Intangible drilling costs through oil and gas is one of the biggest gifts the government's ever given us in the Internal Revenue Code. And this is not new. This has been around since 1913. This is what the wealthy do. So I've got several physicians and a lot of physicians that we work with, and they, especially there's two ways, right? You've got passive income and active income. So you got K1 income if it's a partnership, you got your W-2 income or 1099 income, right? How do you offset your W-2 or your 1099 income? There's not a lot of ways. You can become a professional real estate person, or you can invest in oil and gas. Those are the kind of the two black and white options. The other options are a little gray. And so I'm going to talk about that because you can reduce your adjusted gross income by how you invest in these things, and the money comes back through cash flow. 1031 DSTs. If any of you own a bunch of rental houses, I know Jordan, you own like what, 69 rental houses now? But whatever, I was there. It's a great way to make money, but it eventually becomes a job. And we all have good jobs. We don't need extra jobs. And you're welcome to debate me on that, Jordan. But at some point, you're not going to want to do it anymore. And there are ways to go and do passive 1031 vehicles to where you don't have to lift a finger. You don't have to deal with tenants. You don't have to deal with trash. You don't have to deal with any of that. It's something worth looking at when the time is right. And if it is, I'd love to work with you. Opportunity zones are going to be huge in the next couple of years. Starting this summer, if you have a capital gain through an LLC, this is a very interesting one. Discounted Roth conversions. I think you guys did a webinar on this recently. That is a massive thing. I do some every year myself. In real estate, you can get upwards of 40% of a discount. In oil and gas, you can get about 50% of a discount. It's a very powerful tool. And then lastly, bonus depreciation. For those of you that own your own practice and get a K1 at the end of the year for several hundred grand and you got to offset that tax, that's when you look at bonus depreciation. So I'm going to do just a 1 minute each on this and see what questions you have just as a teaser, okay? Oil and gas. This is an interesting one because you can lower your adjusted gross income by what you contribute. If you put 100K into an opportunity, and by the way, these are not wildcatting things. This is a fund with 150 wells in it in the Permian Basin. It's already de-risked. We're basically investing with ExxonMobil and Chevron and Devon Energy and those kind of people. But the beauty of the IDC is 85 to 90% of your investment is still your money's still invested. You didn't lose the investment, but it comes straight off your adjusted gross income through a passive loss, through an active loss on the K1. It comes straight off the top, adjusted gross income. So in this example, I've got 608,000 married filing jointly. And by putting 100K in, they were able to reduce their adjusted taxable income down to, actually, I take that back. They invested, what was it? I think it was 120. My slide doesn't tell you. They put 120 in, they got 108 of a deduction. The point is, it got them down to that 500 level. Why does that matter? Because the SALT tax, the SALT credit phases out at $500,000. So if you make above a $500,000, you lose that SALT deduction. That SALT deduction is 40 grand. It drops to 10 grand the higher your income is. And so by investing in this deal, not only did you reduce your marginal rate from 35 to 32, but you brought that extra 30K back from the SALT deduction. And you saved money on the amount that you got reduced. So there's multiple benefits that you can look at here that we work with people to say, hey, this is now the oil and gas deal that gives you these credits. It's about a 1.5 multiple. Okay. It's a good return. It's not this crazy return, but it's a good return. You'll make your money back in 3 to 4 years. But the tax benefits are just such that if you're not aware of this, I would love to educate more on this and maybe I can come do a follow-up. But this is a very powerful tool. There's a lot of ways that you can use this from a tax planning perspective, and the money's coming right back. If you pay the tax, that money's gone forever. If you do this and get the tax break, you might uncover more deductions and the money's going to come back in 3 to 4 years. So that's one thing that we're a big fan of it. The 1031 exchange, really simple. If you sell a rental house that you don't want to manage, you can exchange into a commercial real estate vehicle as a fractional owner. And this is powerful because you get the cash flow of that institutional real estate that you couldn't afford to buy on your own as a percentage. And you don't have to pull a loan. You don't have to manage tenants. You simply get paid every month. It's generally 4 to 6%. It's not the biggest cash flow in the world, but it's cash flow that you didn't pay tax on because you're going to pay capital gains, you're going to pay net investment income tax, and you're going to pay state tax, and you're going to have bonus recapture. All of that stuff hits. You go into this, they depreciate that more. Your income is now tax free. It's basically a real estate muni bond. And what you're doing is you take that, what became a business, and you monetize it into cash flow. So let's say you bought a house for 400 grand and you're getting 5% cash flow on the 400 grand. Well, what if that house grew to 700 grand? That extra appreciation you're not getting any benefit on until you sell it and take the 700 grand, and now you get 5% on the higher dollar amount. You just grew your cash flow by what, 70, 80%? That's why people do this, right? Plus you still get the stepped up basis for your heirs, so it's a great estate planning tool. Qualified opportunity zone funds, this is a big deal. Any capital gain can get deferred in the new rules, and there are ways where there are a few of these vehicles out here that will offset 100% of your capital gain tax. Most people don't know, even this year, there are ways to do that. People don't know. They think, oh, I just defer it and I'm still going to have to pay it. Yes, unless you go into a certain vehicle that has a mechanism that allows you to offset it. We don't have time for this because I'm already 50 minutes in, but this is a very powerful tool going forward I'll share these slides that I want to make sure people are aware of. The new QOZ 2.0 rules are really, really good. They made this permanent. This is not going away. This is the super Roth, is what they call this. There's two terms that crack me up. One's the super Roth, the other's the Roth for the rich. I'm like, hey, call me whichever one you want. I don't care, but I want to do this. So, Roth conversion at a discount. You want to be Roth. You want to get your money out of your traditional IRA. You can use real estate or oil and gas. It doesn't matter. The deduction on this is roughly 40% in real estate. I've got one right now. It's 42%. Oil and gas sometimes can get you to 50. It just depends on your comfort level with the asset classes and how you do it. I do some every single year. I want to retire Roth. I would encourage everybody else to do the same. It's very easy to do. We help people do it all the time. Last thing is bonus depreciation. There are bonus depreciation vehicles where you can get multiples on your investment in depreciation. The way you do it is, well, first off, you got to have somebody that helps you find these vehicles. But there are ways to get multiples on. So you put 100 grand in, you can actually get 100 grand to 200 grand in depreciation. Why is that valuable? It offsets that K1 partnership income. And for physicians groups, especially for those of you who own your own practices, that could be huge. Now, one caveat, depreciation has something called recapture, and they're going to tax you 25%. 25% is better than 37%, but it puts you on a train like the 1031 train where you got to continually find new properties. That's what happens in depreciation. So people who use this, they'll take it, they'll offset tax. Then when they come out, they go back into another one to offset tax, and then they go into another one. The beauty, though, is you generally only need to put half in the new one. The other half goes in your pocket. So it does come out, you do come out ahead, but it's just something that we try to help clients understand going forward that there are ways to do this. Those are a lot. That's a very fast way to go into some very complex tax planning. And so I apologize to do that. I just wanted to kind of tease you guys with some ideas. We would love to have the opportunity to work with you at some point if it makes sense. I think there's some more stuff in the chat there, Jordan. Are there questions we can talk to?
Yeah, there's some questions. That was just an incredible overview. Tons of information there. First question, just about kind of clarifying in terms of the model of investing with you. Is it investing via a fund or is it recruiting for each individual deal, more like a syndication? Can you just briefly kind of talk on that?
Yeah, I appreciate that. It depends on the vehicle and it depends on the individual what's better for you. Some people are better for A versus B. So we have both as the answer, right? We do have fund vehicles. We also have deal by deal vehicles. And it depends on what the opportunity is, and it also depends on what's right for you and where you are in life.
Awesome. Next question is when you were talking about investing in medical offices and properties, for the medical fund depreciation, is that something you would get a K1 for? I'm assuming so.
Oh, it's a K1 vehicle. Absolutely, it is. So the bonus depreciation on the medical fund is going to offset 100% of the income. And in year one, you're going to get an additional 30% of depreciation over and above your investment that you could use elsewhere.
Okay, awesome. And then on the oil and gas side, um, the write-off is for the first year, and then what happens after that? Do we liquidate at the end of 3 or 5 years? Do you have any mineral right on that fund, or is it just the oil and gas production? Could you kind of just talk on that a little bit?
Yeah, so typically your opportunities in mineral rights are going to be mineral rights only, and your opportunities in drilling are going to be drilling only. You don't necessarily see them commingled because they do two different things. Okay. So what these vehicles do is they have high cash flow. Mineral rights are generally in the 8 to 14% annualized cash flow. It's unbelievable. Oil and gas starts out high. You could get 25 to 50% of your money back in the first year. Not unheard of. You could get all your money back in 2 to 3 years through cash flow. But the beautiful thing is these wells run for 15, 20, 30 years. Like they just don't stop. So you got all your money back, you can reallocate it elsewhere, and you just have an income stream that just continues to happen. So that's how it works. It's not like it's sold someday because there's no recapture. That's the beautiful thing about this side is unlike depreciation that has a recapture, there's no recapture here. And so what it does, it just creates cash flow for you forever.
Yeah, that is such a powerful thing. Um, well, that was amazing, and we're pretty much right on time. That was honestly such an incredible overview of so many different opportunities, and I think shows the range that you have and are able to offer. So thank you so much for taking time and going through all of that with us. For those who join live, thank you also for joining live. If you're watching the recording, thank you for watching. We have all of Rob's contact information here, and we'll be sure to send the recording along with contact information as well. So, Rob, thank you so much again. It's always a pleasure doing these sessions with you, and I know I learned a ton. So, thank you.
Absolutely. Appreciate the opportunity.
All right, have a great night, everyone.
Feel like an Italian barista at home.